Or good morning if you're dialing in here from the west or mountain region. My name is Brian Cancian, Business Development Manager here with Foundation. It is just now the top of the hour, and we've got a pretty good group registered for this session, and people are trickling in. So we're gonna just hang tight for another 3 or 4 minutes before we get started. So sit tight, and we'll be right back with you. All right, everybody. Good afternoon. My name is Brian Cancian, again, Business Development Manager here with Foundation Software. We still have a couple people trickling in, but we're going to get started with today's session. I want to thank you all for joining us to the Contractor's Guide to Smarter Reporting and Stronger Profits. With us today, we have Melissa O'Shea of Sachs LLP, and she's going to be discussing smarter job cost reporting and how you can transform your bottom line and lead to stronger profits. She's going to talk about some practical strategies and real-world tools that can help you take control of your financial outcomes and ultimately just drive greater success within your organization. Some quick housekeeping before we get started. We will end the session with an open Q&A. So everybody in attendance here is muted. If you would like to ask a question, there is a icon at the top right-hand side of your GoToWebinar window. The question mark will open the questions pane. Please feel free to type your question there and submit it. You can do that at any time throughout the webinar, not a problem at all, but we will be holding these questions until the end of the presentation. So please do be patient. What else? Like I said, we have some dedicated time at the end, and also everyone is going to receive a recorded copy of this session. It does take some time for GoToWebinar to process it before we can send that out, but if you are registered, you will receive a link to the recording. So let's jump into this. Again, my name is Brian Cancian, Business Development Manager here with Foundation Software, responsible for many of our partnerships and integrations, et cetera. And with us today, we have Missy O'Shea, partner with Sachs LLP. And so with that said, I'm going to turn it over and let her do a quick intro of herself and continue with the presentation.
Perfect. Thank you, Brian. If you could just go to the next slide. Yeah, perfect. So as Brian mentioned, my name is Melissa O'Shea. I do go by Missy if anyone's looking me up, either or works. Little bit of a bio slide on me, kind of just going through, you know, they like to highlight some of the accomplishments. But I wanted to give you a little bit of background onto why it is relevant for me to talk about this topic today. As it shows, I'm a partner at Sachs LLP. I've been with the firm for 15 years, and the entire time my specialty has been construction contractors. My client base is mostly New York, New Jersey, all privately held construction contractors ranging anywhere from the $500 million GC to the $30 million electrical subcontractor. So what I'm going over today and what Foundation asked me to speak about is extremely relevant to what I deal with on a daily basis. So just giving my 2 cents on how to build this playbook for a better profit. Next slide, please. So I always like to go over the agenda and what we're going to speak about today. I like the presentations and my trainings to make sense. So our agenda for today, just going to go over the objectives of what we're hoping to accomplish. And then we're going to go over why reporting is crucial to your business. May seem a little silly, but you'd be surprised as to why people think it does and does not matter. Then we're going to go through what I'm calling the reporting framework for construction, which is how we're going to put this reporting playbook together. Then we're going to go over what I think are some of the key and most important metrics for construction contractors. So that would be the what we're measuring and putting in our profit playbook. And then we're going to bring it all together at the end to build this playbook that you can hopefully repeat and use over and over again. And then the last 2 items, just some common mistakes that I see in my daily dealings and how we want to try to avoid them, and just the main takeaways from today's presentation. Next slide. So the objectives for today, although it may seem obvious by the title, just kind of wanted to go through. We want to understand how a structured reporting can help drive the profitability of your construction projects. We're going to learn, as I mentioned, the key metrics that I think matter most and why. Recognize the common reporting mistakes, and we want to avoid those, and then learn that repeatable playbook for consistent reporting. So ultimately, we want to build this reporting system that makes your profit visibility an automatic thing. That's the hope. Next slide. So again, as I mentioned, we're just going to start with why. May seem a little silly, but I like to highlight this a lot of times to my clients. As I mentioned, my client base is privately held construction contractors. So putting together formal reporting processes is sometimes a bit of a struggle and a little bit of a pushback until we show why it matters and what it can do for them. So just a couple of things, obviously, to keep in mind. If you're a construction contractor, you know these things already, you're living with them. But for the rest of the group, CEOs, finance managers. So the first item, obviously, is tight margins. The construction industry has always been a highly competitive industry to operate within when you're bidding on projects. Pre-COVID, and then especially post-COVID, the bidding and estimating has gotten even tighter. The margins have gotten tighter. And then you add in the tariff back and forth situation, price escalation, the increased price of copper that we've seen. So your starting margins are even tighter than they used to be 10 years ago. So there's really no wiggle room for this 2, 3, 4% profit erosion anymore. This reporting can really mean the difference between a profit and a loss for your business. The next, as to why it matters, is what we call these hidden items. They really shouldn't be hidden, which is kind of sort of the point of today in the conversation. So items such as profit erosion, excess labor, unapproved change orders, back charges. The ultimate goal with this reporting process that we're going to put together is to uncover these potential hidden items much sooner. We really want to be proactive rather than reactive. You really can't do anything after the fact. The next item is timely decision making. You know, the way the construction world works, you need to be able to make accurate and good decisions very quickly. And if you don't know where your business is or where your jobs stand or what money you're making or not making, you're really making those decisions blind. So that's not really where we want to be. The next item is resource allocation that I've seen a lot. If you, like I said, don't have proper reporting for each of your jobs or each of your divisions or each of your project managers, you can't make those decisions on how to properly allocate your resources, such as labor, such as your crews, such as your equipment, such as your equipment rentals. Those really need to go through a strict schedule on a regular basis, and you need to know how the jobs are doing to make those proper decisions. And the last item, which is a big one, and I'll probably repeat it multiple times today, is it enables the accountability for the project managers and the supervisors. This profit reporting and this playbook and these metrics is not just the responsibility of the finance team. And I think that's the biggest issue and pushback that I see in my daily dealings with my client base is they put it all on the finance team, and that's really not how it should be. The PMs and the supers know the jobs better than anyone else, and they should be the ones to help explain and be proactive with how to keep the jobs on budget. One thing I do want to caveat with that is this reporting playbook and how we're putting it together will allow for a lot of transparency on the jobs, which is ultimately what we want. But you do need to be careful with who you want to see what. So for instance, it could be a good thing if you have all the project managers be able to see all of the jobs that are going on, but it could create some tension as well. So just keep that in the back of your mind. If you have one PM, his job's doing 20%, and you have another PM, his job's doing 10%. We just don't want to create this environment of pointing fingers, maybe using it as a negotiation tool. So transparency is a good thing, but just be careful with how that's handled. And I'm going to repeat this as well. So good reporting is the bridge between the field and the financial. We really want to connect the field and the financial outcomes. Next slide, please. So we went over why reporting is crucial. Now we're going to go over how we're going to accomplish that reporting. So a lot of businesses, not just construction contractors, but a lot of businesses don't necessarily struggle with having the data or the quantity of the data, but they really can't pull it all together to make it useful for the future and for their reporting. So this reporting framework that I kind of came up with is going to put together these principles to help align all of the data. So a lot of people struggle on where to start. I actually have, maybe you would or would not be surprised, I have a lot of clients that sometimes call me and they're just like, am I making money? Like, I don't know. Am I making money? So part of that is knowing where to start and how to build these metrics and this reporting so that you can answer the question yourself. So it's a little kind of sort of cliche, but it works, to be quite honest. These 3 C's. So clarity, again, very obvious. We want everyone to know what is being measured and why. Very simple. Then we have consistency. Everyone was reporting at the same time in the same way. We don't want everyone just willy-nilly doing what they want to do, because then you can't compare anything. And then the last part of it, which is typically the biggest struggle, is connection. So you really want your field, your finance, and then your last is your forecasting to talk and be connected to each other. And that's where I see a lot of the downfall, is maybe not embracing technology and what's at our fingertips these days, or the lag between the field and the finance. That lag is just, again, your reaction. You're not going to be getting anywhere with that lag. So again, this is my version of where to start to build this playbook. Next slide, please. Okay, so I'm just going to go through each one of the 3 C's and just elaborate a little bit, again, for erring on the side of everyone understanding what I'm talking about. So clarity, starting with the first one. So the first item you want to do as best you can is standardize your cost codes. So I'm talking about your main labor, equipment, your subcontractors, your material. You want those cost codes to be standardized across all of your jobs. We see a lot of, kind of to the next bullet point, these general cost codes, or miscellaneous or yard or catch-all. You really want to avoid those. It seems extreme, but they destroy your visibility, exactly like it says on the slide. If you throw everything in those codes, you're not going to know what's in there. So the point is to be able to see all the detail, and a general code just doesn't accomplish that. And a lot of times when we see them using the general code, that becomes the line item that's the issue with the budget. Ask the question. By the time someone investigates and looks into it, it's either too late or they get pulled into something else, and then you blink and it's the next month and you have the same problem, repeatable pattern, and you never actually figure out what's going on. So really try your best to avoid those general codes. Obviously, I know with schedule of values and bidding and estimating, there are a lot of general provisions within the contract, but you still want to try and disaggregate those in your record. So for example, you could do a general dash mobilization, general dash allowances if you have allowances in your contract. So at least that way you're still matching what the schedule of values, their contract, or the bid says, but you're disaggregating within your own system so you can have a better handle of it. So that's talking about the codes. The next part of clarity is making sure the metrics that you choose are defined. Again, if you can't define it, then you can't measure it. It happens in my business. It happens everywhere that people are just spitting out metrics and ratios and numbers, and no one really knows why we're talking about them or what they really mean. So we really want to make sure we define those key metrics that we're going to be using in our playbook. So just for example, estimated gross profit versus earned gross profit. Yes, those two can be different. Backlog versus work on hand. We see that one a lot. As CPAs, we talk about backlog. That's what's disclosed in the financial statements. Typically a completely different calculation and numbers than when the bank or the bonding company asks you for a work on hand schedule. And then the last one, just to point out, most contractors, if you have long-term contracts and or you're doing AIA progress billings, that means your accounting is probably on percentage of completion, which majority are. I know it seems silly, but you want to make sure percentage complete is defined, especially for your PMs and your supers. Technically speaking, not to get too nerdy, there could be input and output methods. Most people use cost to cost as the input method, but it could be labor hours as some other input, and or it could be an output depending on the makeup of your jobs. So again, when we're talking about percentage complete, even though it may seem like people should know what it means, you still want to define it. And then the last part when we're talking about clarity is we want to establish a reporting purpose. So each report should answer a question. Again, we just don't want to spit out like numbers and graphs on a spreadsheet and no one having any idea what they're telling us or why. So you really want to start with the question that you need answered, such as, are we on budget or are we billing in line with progress? And then develop the metric and then the report that's going to answer those questions for you. If you don't know what the metric is telling you or what the report accomplishes, then either you're not properly defining things or that report needs to be altered or replaced into something that's actually useful. So that's just going over the clarity side of things of step one. Next slide, please. So the next C is consistency. So this is also a struggle of a lot of contractors, again, depending on your size. So you really want to determine what is getting done, when it gets done, and you have to stick to it. This is where a lot of people struggle, depending on the size of the business. This can be very, very hard to do. You have a lot of moving parts and a lot of moving people. You really want to try to stick to a rhythm that will work and help get you to where you want to be. And that participation has to come from everyone. A lot of times we see, not to call them out, but everyone but the owner doing what they're supposed to do in the regular meetings. if you want to see your profit and you want to see your business, you have to hold yourself accountable as the owner of the business, just as you do everyone else, and really stick to this schedule. What I have beneath is just a suggestion of what I see on a regular basis. So don't take it as the end all be all, but again, as an example, daily, you want to get all the field logs and get those updates. Weekly, you want to go over your project cost and those variance differences and review those. And then monthly, you want to prepare your WIP, go over that summary, and look at your top level executive reporting type things, AR, AP, backlog, stuff like that. So again, just a suggestion of a cadence to kind of keep in mind for how often you're going to do these things and what you're going to do. The other item of consistency is, I'm going to use the word same over and over again, but you really want to implement standard project templates for your reporting. You want the same information in the same order on the same format with the same definitions. That is the only way it's going to be consistent, and that's the only way that you can compare these metrics, these jobs, these crews, whatever information you're looking at. It all has to be in the same format, in the same order, and everyone understands that. So you could build these templates for what everyone can use, instead of everyone reinventing the wheel every single time you ask for information. And then the last item related to consistency is you really want to train your PMs and your supers on how to read and use the same reports. Again, I talked about in the beginning, and I said I was going to bring it up again. It's not just on the finance team to understand and explain these metrics. So if the PMs and supers don't understand the reports or what goes in them, that's step one, because then they can't explain when you come up with variances. If they can't do that, then you're missing a piece. It's really just not on the finance team to uncover the issues. A lot of times we'll come in, as the CPA, and we'll be preparing the financials or the POC schedule, and we'll ask about a big underbilling or something like that. Then the accountant will have to ask the PM, and then the PM either doesn't really know what an underbilling is or means or can't explain it. That is not what we want. The PM should absolutely be able to tell you, and then you use the accountant to interpret that what they're saying makes sense and is driving the underbilling. So we really want to get the PMs and supers involved. Like I said, they know the job better than anyone. Next slide, please. So the last of the 3 C's, as I mentioned, is connection. The first one is starting with field integration. So you really want to connect your daily field reports to your job cost systems. So your time cards, your equipment usage. Again, I'm not going to necessarily push technology. I'm not going to necessarily push AI. I understand making those shifts. As I mentioned, I work with privately held contractors. They could be 5th generation. They do things old school. I get it. But as much as those items can be connected is how you're going to get the most accurate and timely results. Again, real-time updates. You want your cost and production should be done weekly. If you're waiting monthly to look at your cost and your production, you're already behind. There's nothing you can do about it at that point. So you want to stay on top of those key items that could really shift a job from profit to loss. As I mentioned, you want to try and automate as much as possible. There are a lot of options out there these days to be able to do that. And then the last thing is you want to understand what we call like a connection network. So you really want to break it out. So you have to look at it as 4 type of categories. What is the source of the information? What tool are you using to get it? What type of data are you pulling? And what's your ultimate output that you're looking to get from that? So again, for example, on the top one, my source is the accounting department. The tool that I'm using is my foundation accounting software. The data that I'm pulling are my cost and billings, and my output is I want a daily production log. So those are the kind of the steps that you have to go through in order to understanding how everything connects and where you're getting that information from. Again, try and embrace technology as much as possible. It's always going to be a learning curve, but in reality, if this is important to you, you're not going to get the results you're looking for on your business and its status and how it's doing if you just keep doing things manually. Manually does not allow for timeliness. It allows for human error. It's just not something that we want to keep doing. Next slide, please. So again, just to reiterate, because I always like to bring it back together, we went over why we care about reporting. We went over how we're going to try and put some sort of reporting together with clarity, consistency, connection. Now we're going to go over what we're going to be reporting on. So again, my version of key metrics for measuring profitability for construction contractors for jobs and overall. And I always try and break it out into categories because that makes it easier to understand what you're measuring and why and how they're connected. And this is also how this industry works and how we accomplish. So the first is your financial metrics. They're very results oriented. So you're calculating what's already happened. So again, what happened? Then you have your operational metrics that are looking at your efficiency and your performance, why that happened. And then you're looking at your predictive metrics. So those are your warning signals and tells you what's coming next. So that's kind of how I categorize the metrics that we're gonna go over. Next slide. So I know it looks like a lot and I don't wanna get crazy, nerdy accountant-y on everyone. But I do want to put out there what we, again, as a CPA that works with construction contractors every day, what we're looking at and what our suggestions are, especially if you're starting out to try and build this reporting playbook of what metrics you should be looking at. So the first one is estimated gross profit percentage by job. This is something that we look at on the regular. Also suggest it's something you look at on the regular. Again, in the heart of defining everything so we know that we're measuring, I provided the definition for everything and then why it matters. So your estimated gross profit percentage by job allows you, I'm not going to necessarily go through the definitions, but allows you to track your weekly or monthly gross profit fade or increase. So it exposes that so you can look into that, and then also reveals your cost efficiency and if you're pricing accurately. So this should be a standard. It typically is a standard of your estimated gross profit. And any of these can be disaggregated or lumped together. So it could be job by job. It could be location by location. If you have different avenues of revenue, like you do fiber optic and then you do this installation, or you also do heavy highway broken up that way, or you could do it by crews or PMs. So any way that you want to look at it. So the next one is earned gross profit percentage by job. This actually can be different than your estimated overall gross profit percentage by job. Typically that happens due to timing, or if you're not updating your total estimated costs for what's been going on the actual cost side. So this metric, it'll highlight any over under billings and also that early margin erosion that we talked about. So a lot of times you'll see the earned gross profit, if it is different, is lower than the estimated. And that's probably because you're not updating your estimated overall gross profit for additional costs incurred. The next one is billing efficiency. This is a favorite of ours. So again, it's your bill to date over your revenue earned to date. And it measures how effectively you're converting your progress and your billings into cash. You can only collect cash if you're billing it. And this is designed to see if you're billing in progress with the work that's actually done on the job. I'll mention this again later too. All of this is great on paper, but profit and cash are completely two different things. And in the construction world, cash is king. So this is a great metric to bring the two together. You're billing on paper and how much are you converting that into cash with this billing efficiency metric. The other one is net profit per labor hour. A lot of contractors like to see this. Again, depending on if you are mostly self-performing, and or if you're a union contractor, obviously these can vary. And also just to come back, I didn't give any good measurements or what's a good billing efficiency percentage or anything like that, because the construction world is so different. And as I mentioned, my clients run the whole gamut of what could be good and what couldn't be good. Again, depends if you're mostly subcontractor, if you're self-performing, and or if you're union, these metrics could be completely different. So that's why I just didn't give key like ranges or anything like that. But a lot of contractors like net profit per labor hour. It looks at your field productivity across all of your projects. And again, you could also do it by crews and or PMs. So you can see how much they're being utilized and the productivity that you're expecting to get out of them. Again, it reveals productivity, and it can be disaggregated if you want to look how one PM is handling the crew or by location, et cetera, et cetera. And then the last financial key metric that I kind of added on there that you don't typically see the contractors doing, but it's a CPA favorite. I can tell you we do this pretty much in every client that we prepare the financial statement. This is part of our analysis, and that's your average estimated gross profit on your jobs that are in progress compared to your jobs that are completed. So it reveals your ability to properly estimate the costs, which is the foundation of making profit in a construction company. You have to be able to properly estimate. So what this reveals, it's pretty simple. If every job you bid on starts at 20, you think you're going to make 20%, and then they ultimately always end up at 12, then something's wrong. Something's wrong. You're missing a cost. You're not building in overhead. You're not building in insurance, or your labor's hour estimate is off. Something is wrong. So this is a very easy one to look at and to compare. Next slide. So we talked about the financial metrics. Now we're going to go into the operational metrics. Again, why things happened. The first one being labor productivity. So again, it looks at if your crews are on track compared to what your budgeted projection is. And based on the definition and the metric, anything over 1 is good, meaning you're meeting or under budget. And anything under 1 means you're over budget and you want to start investigating. And again, these are metrics that you would use on a regular recurring basis so that you're catching these things weekly as they're happening. Another one, change order cycle time, pretty simple. The days from when you initiate a change order to its final approval or billing. It could answer some of your cash flow issues and any of your gross profit margin decline. Because obviously if you're not building in those change orders within a reasonable amount of time, your gross profit is going to go down during that time that they're not built in. Equipment utilization is another one. If you own or use your own equipment versus renting, so active machine hours over the total. Again, it can highlight your underused assets, and it can also highlight your rental inefficiency. If you're renting, but you have all this equipment on your own that you're not fully utilizing, that's a metric that you want to look at. Employee crew utilization rate is a big one. It kind of goes hand in hand with the labor hour metric that we just talked about. It really just helps you look, are your labor resources fully leveraged or are they idle? It's a big metric across a lot of industries, not necessarily construction, but even more so because most of your laborers or your crew members are paid by the hour. So if based on your business, let's say, for example, you come up with a utilization goal rate of 85% for your people, and all of them are coming in at 75%, then you either have, you might have too many people and you could be overstaffed. Maybe you're okay with hanging on to 1 or 2, especially if you're union, as it's harder to find those quality workers and hang on to them these days. You may keep them even if they're not on jobs. But either way, it's a good highlight of your goal and what you're willing to accept as far as what your goal is and your actual utilization rate. So another big one. Last one of my favorites on operational. So cash flow by job could be financial, could be operational. Honestly, I added it here because I had more room on the slide, but it could go either way and is still important. So this is a big favorite of mine. As I mentioned before, cash is king in the construction industry, and it's really gotten tighter, as I mentioned, since the pandemic and additional tariffs and some price escalations. So looking at your overall business profit, even and or job by job, is one thing, but having the cash in your hands is another. It's completely different. So this can highlight problem jobs, problem customers, or even PMs or your supers if they have the responsibility to bill and collect, like which ones are not doing that. So unless you have, you know, a pretty significant or unused line of credit to support it, if you have one job that's quote unquote in the black, that means that the other jobs have to cushion it to be able to float that job for cash flow. And if you have more jobs that keep coming up in the black, it's going to be more and more of a problem. So again, another favorite of mine is cash flow by job. Next slide, please. Okay. And then the last set of metrics in the categories is predictive. Like I mentioned, what's next? Pretty simple. Your total cost budgeted versus your actual. So positive means you're coming in under budget. Negative, you're coming in over budget. Again, another way to measure your ability to properly estimate and manage all of your costs. Backlog, you see this pretty much in every financial statement that a CPA prepares. It's required. It's essentially how much revenue is left your future work to complete. And you want to look at this as, do you need more to cover your overhead? And do you need to get a little bit more aggressive with your bidding? And do you have the right crews in place to handle if you have the opposite, where you have pretty significant backlog and you want to make sure you have the labor to handle it? Your bid to win ratio. So obviously your awarded bids to your total bids. It could indicate some sort of pricing mismatch, or on paper shows the competitiveness of the market that you're in. I'm sure you feel it when you lose a bid, but it's nice to have it on paper to see how often that happens, if it's with a certain customer, certain types of jobs. Again, it just puts it all in your face. And then revenue recognition variance. So your earned revenue less your billings will obviously show you your over under billings, and could also have some cash flow explanations. It's pretty similar to the billing efficiency. Are you billing in progress with how the job is actually moving? So those are the three key metric categories. Next slide, please. So I just wanted to highlight very quickly, yes, Foundation asked me to do this webinar. They didn't ask me to plug anything, but it just so happens to be that Foundation is my preferred construction accounting software. If you're trying to switch from QuickBooks, not hating on QuickBooks, it works for a lot of people. But if you're looking for the next level of sophistication and not having it too hard to use or too hard to understand, it legitimately is my number one referral to all of my clients. Whether it's Foundation or not, I wanted to highlight one of the items that Foundation offers in its software, and it's called this executive dashboard. So again, whether you don't know it's there and you have Foundation and you can use it, or you're trying to build your own, this is a good way to highlight kind of sort of what I'm talking about. So when you go on the executive dashboard, you can see the tabs at the top, and it covers all of the key areas at the high level. Like I said, like a CEO or an owner would want to see. It's executive level. So the first tab that you see here is the job costs tab. It gives you your billing and profit totals by job, and also lists it out on the right so you can see where you're at. Next slide. Then the next tab is change orders, another good thing to track. Remember, this is at the executive level. So it gives you your change orders. You can see your original, your approved, your revised, your pending. It also gives you your by job and your metrics and your over under billing. And then beneath that, I'm sorry, can you just go back one more? And then you have your financials tab. So again, if you look at the top, financials tab tells you your income statement by month, if that's what you want to look at. And then also your over under billing per job. There's more information below. I'm just highlighting what the graphs say. Next one, please. Then you have your cash tab, which we keep talking about cash. So where your cash accounts are at and the cash balance. It also has the cash flow, received, paid, net, and then it also has a cash flow by job, which I mentioned before. So that's already built into this executive dashboard. And then next slide. And then your last two tabs, like you can see at the top, you have a payables tab and a receivables tab. So again, I just wanted to highlight what Foundation has as their executive dashboard as an example of building your own and or using it. These are the key tabs and the key items that we're talking about: job costs, change orders, your financials, your cash, your payables, your receivables. So just wanted to give an example because I think it's a great tool. Next slide, please. Okay. So we went through why we care about reporting. We went through how we're going to build the type of reporting. And then we went through what we're going to report on and what metrics we're going to use. So now we're bringing it all together to build that reporting playbook that we talked about. So like it says, we're going to bring everything together in one place, real time, and it needs to be readily available. You shouldn't have to build it every time you're trying to look up this information. So again, you want to define your objectives. What decisions do you need to support? Start by asking yourself the question, which I mentioned before. What things are you looking to know? Are we on budget? Are we billing in process? Are our crews fully utilized? What's our cash flow? So start with asking the questions and those objectives to be able to start. And then again, answering those questions is going to clarify why before you start designing that report. Then the next is selecting the key metrics, which we just went over those items, and I broke them down into financial, operational, and then forecasting in the future. So you want to standardize those metrics. We talked about the consistency part of things, and you want to focus on the biggest cost levers. You don't want to spit out a million metrics and ratios just because. Again, you want to, especially if you're starting out, you want to stick to the key items that could really move the dial for you, either overall or per job, and then you can build and disaggregate on that. Then you want to design those templates. Remember, you want them to be uniform and consistent. You're going to standardize what you consider your KPIs, your thresholds, what the reporting looks like, and that helps you identify those core reports. Those templates are available to everyone that's participating in this process. And then I mentioned you want to automate as much as possible your data flow. So try and integrate the systems that you're using, your bidding software, your financial reporting accounting software, and then your field data, however that's coming in. Automate some alerts if you can on certain jobs, set your thresholds so that it flashes you in the face when something's going wrong. And then that's essentially building the reporting playbook. And then you want to review it and you want to repeat it and do it over and over again. So create that reporting cadence calendar that we talked about. What are you going to do weekly? What are you going to do monthly? What are you going to do quarterly? And then you want to make sure you meet with the PMs specifically to go over profit review and anything that's directly related to their responsibilities. So a lot of it being profit. Next slide, please. Okay, so went through building everything and how we're going to do it and what we're going to put in it. I just wanted to bring up some common mistakes that I see in my daily dealings with my construction contractors. I could go on and on and on, no offense to anyone, but I picked the top three that I think are really relevant. So the first one, I've mentioned it probably 3 or 4 times at this point, is the disconnect between the field and the finance team. The project managers see one version and the finance team sees another, and then your ability to accurately forecast is just gone. You really, really have to try and connect the two and integrate your field reporting with your financial to get what I like to call one truth. A lot of times, as I mentioned, everyone has their own version of the truth. The PMs are saying one thing, the finance team is saying, well, the numbers don't. We say the math doesn't math with what you're saying. So if you connect the two and hold them accountable in these regular meetings, then there shouldn't be that disconnect anymore. The next one is you're reporting too infrequently. By the time the reports are done, the team has moved on and those cost overruns are done and locked in. There's nothing you can do about them at that point. So again, you want to move to a weekly project dashboard with key metrics. I know weekly is hard, but that's why you want to stick to the key, which is those project costs. They really should be done weekly. And then you're not forecasting your cash flow alongside your profit. This is my last mention of cash flow, cash flow, cash flow, cash flow. You can show profit on paper, but you can run out of cash in reality, which I've mentioned many times. So you really want to include a cash flow forecast and your billing efficiency as your key metrics. I would really push to include those. So those are my top 3 that I see on a regular basis. Last slide, please. So as I mentioned earlier, I like to bring it all together, as I mentioned. So again, we went through why we're doing it. We went through how we're doing it. We went through what we're doing and then pulled it all together. So we really want to go from reports to results. So mentioning again the 3 C's, Clarity, consistency, and connection. That's going to help transform your reporting from just data into some sort of action. Again, it can be all numbers on a piece of paper, but until you bring it together and make it make sense, it's not going to help you accomplish anything. You want to focus on a few metrics that predict your profit outcomes. Again, if you're just starting out, keep it simple. Work on the ones that actually mean something and can move the decimal for you. Standardize and automate your reporting. You want to reduce the lag and improve the accountability. So the more standardized, easy to access, understandable templates that you have available for everyone, the more efficient you're going to be able to do with your time and keep that cadence calendar. And then lastly, you want to assign ownership. It shouldn't be whoever can get to it. You should define for your finance team who's doing what, when, and why. Define for your PMs who's doing what, when, and why, so that everyone has that accountability and ownership that they should be participating in this process, because profit for the company does directly affect your staff and your employees' pocket, compensation, the future. So we want to hold them accountable and give them the ability to do so. So I think that pretty much wraps up me going through how to build a reporting playbook for better profit. You're on mute, Brian.
Thank you. Thank you, Missy. That was great. A lot of interesting points. I believe that we have a poll that we're going to kick off before we open it up to Q&A. And while that's going, I was just curious, as you were talking about your, the consistency of data and the importance of estimating. And I spent a lot of time out in the field, and everybody has an estimate with, quote, overhead.
Mm-hmm.
And what I found is that a lot of people lump all of their overhead, their G&A, and all of their construction-related overhead into one bucket, and there's no separation. And I know there are systems out here, Foundation included, that really have great abilities to add that overhead, the construction portion, in. So being able to have an allocation for shop-related costs, whether that's as a percent of labor, dollar amount per hour, allocating truck costs and all these other things out there. And I feel like a lot of companies out there just miss the boat when going through their setup and implementation to really start hammering out these indirect expenses to really know what that cost of construction is. Because those G&A expenses aren't really going to change
correct
year to year, aside from salary increases or really adding or taking away from the staff, right?
Correct.
Construction related overhead costs fluctuate a lot depending on the volume of work you're doing.
Well, I think I see a lot of contractors get confused with what overhead means, to just start there.
Yeah.
So they think overhead just means the G&A consistent expenses, which is not necessarily the case depending on how they view their business. So as you mentioned, like the G&A should be fairly consistent. Those are the costs that we consider that are going to happen whether you're doing $20 million of business or you're doing $100 million. Typically your G&A salaries, like I said, unless there's increase, are the same. Your rent is the same. Your utilities are the same. All of those items are consistent. So you should have a fairly consistent percentage to keep in mind when you're bidding your jobs. Then the other part of it is the direct overhead, which a lot of time clients or contractors forget about, that you can't easily allocate when the cost is incurred. So insurance, depreciation, repairs and maintenance, those are a lot of the items that we see that don't get allocated. And a lot of times we're the ones that come in at the end of the day and we're like, oh, you have $4 million that we need to spread across the jobs. And they're like, what?
Right.
So there's certain ways to deal with that. Foundation certainly has methodology to do that, which I love. A lot of clients will throw things to a catch-all like yard or like 9999 job that's not a real job. And as you mentioned, Brian, Foundation has the ability to do these allocation entries as often as you want, and you can tell it how you want it allocated, whether it's on profit hours, whether it's on cost to cost, whether it's on billings, however you want to do it, there are allocation methods. So yes, the term overhead is a hot topic on the regular.
Yep. I always try to simplify it as best as possible. You know, if you can pin that number down, if you're capturing those job related overhead costs into its own set of numbers on your financials, it's pretty easy to look historically, and whether it's as a percentage of labor dollars or a dollar amount per hour, you know, the easiest way that I found to do it is to allocate it right through what we call extra burden in payroll.
Mm-hmm.
Add that on, it follows the guys. You can add it on a per person basis. So if you want to charge off somebody's truck on an hourly rate out to a job, you can do that. You know, cell phones, anything that really it takes to run those projects, get that added in the simplest way possible. And you have a really good estimate versus actual number then, right?
Yes.
You know, like you said, you don't want to get to the end of the year thinking you're making money on all these jobs, and you did, right? You showed a profit on all these jobs, but you lost money.
Yes, or a lot of times they're using the same direct overhead allocation rate as they were 5 years ago, and it's not the same. So if that is another method that we see clients do, is they apply like an hourly overhead rate to try and capture those costs. So then essentially left in that 999 job should be net nothing at the end of the day, but you need to update the allocation hourly rate.
Yeah.
So.
And monitoring that as you go throughout the year, right? You know, seasonally, right? You could have a ton of overhead costs, especially if you're equipment heavy in the colder months, doing a lot of the repairs and maintenance and the major overhauls of these things. But then there's very little cost as you get into the actual construction season. So you've got to put that, you can't burden all of those activities, you know, all of those costs you're incurring in the cold months, you can't put on the jobs you're doing in the cold months. It has to be a pretty equitable distribution.
Yes.
In any event, yeah. So we'll open it up to Q&A. Looks like currently there are no questions yet submitted.
That just means I did a great job of explaining everything.
That's what my thought was. Is there anyone out here that has any questions for the expert? Well, Bree says you did do an excellent job.
Oh, thank you.
So there's an exclamation point, not a question mark, so no answer necessary.
Not too shabby, I'll take it.
Agreed. Anybody else out here? Jake has one, throwing out a question. I'm new to Foundation. Can either of you help out with how to get started with the reporting? The short answer to that is yes. We probably aren't the best resources from here. Foundation does have a consulting department with experts in this area in terms of how to address the overhead, like we were just talking about, going through the setup and various types of reporting and some of the best practices. So I don't know if you're still in the implementation phase, in which case I would talk directly with your implementation specialist. If you are beyond training and you guys are already using the software, I would reach out to Foundation and the consulting department to maybe schedule some time with one of our consultants to do that, unless you wanted to engage with Missy and Sachs and go from there.
Well, I was going to say, just to add on that, I happen to be pretty savvy with Foundation. I have a lot of clients that are either on it or transitioning from QuickBooks to it. We do help with that transition. I just met with a client a couple of weeks ago that we just, I think, sat for like 3.5 hours. And I just answered all of her questions. My own accounting team at Sachs just got our own personal 2-hour demo on Monday from the training team to go over the basics. A lot of times the CPAs and accountants, because we're the ones that do the financials, we don't do like the data input, like the AR, the AP billing and reversals and progress bills and all that stuff. But we did get a demo to learn that, so we know it better. The last thing I will say is that Foundation is very user-friendly. A lot of their standard reports that are available actually do answer all of your questions. The reporting is only good as the input. The output's only good as the input. So that's what I see with a lot of clients, that they're not inputting the budget, they're not putting inputting the contract, they're not attaching their invoices when they enter it, or whatever the case may be. So as long as the data is there, the software actually has some really good pre-programmed reports You just have to know how to alter them. And then the last part is they do have like this data genie where you can customize and essentially build really any report that you're looking for. So just a couple of thoughts.
Great. Another question, and I think this goes back to some of those overhead conversations we had. Best practices for owned equipment costs per job. And I'll say one thing here as we get into foundation. If you happen to own the equipment module, that can be set up to allocate the utilization of equipment out, whether that's along with a guy's payroll time or whether you post it to a job separately, and you can associate a cost per hour, day, week, or month to that particular piece of equipment, in which case it then allocates an expense directly to the project and creates a contra expense entry into that area of your ledger where you should be capturing the indirect costs of those equipment items, whether it's depreciation, maintenance, repairs, etc. And if all goes right at the end of the year, they would net out to zero. You never do that. We get close, and then it's just, do we adjust our rates for the coming year?
Mm-hmm.
Beyond that, Missy, what do you think, if we don't own the equipment module or we choose not to utilize it that way, how would you allocate owned equipment cost out to jobs?
Yeah, so you can still, there's, as we mentioned before with the overhead, there's kind of two methodologies. So when you're talking about equipment costs, you're typically talking about depreciation, repairs and maintenance, and fuel. Fuel is a big one that we see if you have like a lot of trucks or even the equipment take diesel fuel. So come up with, so either those three costs, like I said, you throw to like an equipment job that you create, and as often as you like, I would suggest at least minimally monthly, you can create that allocation entry in foundation. And a lot of times we see it based off of labor hours utilization, because the job that has the most hours is probably using the most of your equipment unless you know something otherwise. So that's one method. You just capture all the costs in this equipment overhead job and then monthly allocate them also across all of the jobs using some sort of metric. Or you come up with an hourly rate. So, last 3 years annually, how much are those total expenses? Divide it by what you think hourly usage is every year. And then it gets entered every time you enter payroll based on the labor hour. And then like Brian mentioned, at the end of the day, the way it would work is that equipment job should essentially have zero cost in it. If it still has positive cost in it, that means your rates are probably a little low and need to be adjusted up, or vice versa. So two methods: catch all and then allocate, or create an hourly rate that pulls it every time you enter payroll and reconcile on a monthly, quarterly, annually basis.
Yeah, I definitely think one thing to keep in mind is that this isn't a science, right? It's a practice, and we're trying to get close. And whether you are doing it through the equipment module for actual utilization, that's probably going to be the most accurate, but it's also the most labor intensive, because now you not only have to have guys report their hours in, but they have to also report what they were using and how many hours they were using it, because just because they're on the job for 8 hours doesn't mean they were using the dozer for 8 hours, et cetera. Mm-hmm. So while it is, quote, the most accurate allocation of equipment costs, assuming the rate at which you charge off to the job is accurate, it is also most labor intensive. Whereas if you did some form of general overhead allocation, capturing all of those costs, whether it's equipment related or just, shop maintenance and repairs and upkeep, you've got shop staff to maybe manage inventory, things like that, all of those job related expenses, but not job specific expenses, we can use those numbers from your financials to come up with a cost and average that out as a per hour basis, et cetera. So, yes, some jobs might get allocated more heavily than what they actually used, and others might be allocated a little more lightly, but you're doing what you can to pick up those costs across those jobs. So there's a lot of options. It's just a matter of which is going to be the best for you. And again, that's where Melissa and her team, or the foundation consulting team, et cetera, can work with you to kind of figure out what that best methodology would be for you.
Yeah, and with everything here, you want to be efficient and smart with time. I don't like spending time just for the sake of spending time. I don't believe in that. So however much it matters, if equipment usage is a huge part of your business, then yeah, you're going to spend more time nailing it down to the detail level. If it's not a huge part of your business, then we want to do the most efficient way of capturing those costs. I'm all about everyone being realistic with their schedule and their time efficiency. So.
Yep. Absolutely. We have one more question here. I don't see any others that trickled in. So this is a good one. What is the formula for over under billing? And though I'm not certain what is a good rate mean, what rate, what amount is good for being over or under, if that's it. Maybe Elaine, if you add some clarity to that question, but we can start with the formula pretty quickly.
Yeah. Okay. I'll try not to get too, sometimes it blows people's minds if you're not a nerd accountant like we are, but essentially over under billing is comparing what you've billed to date to your earned revenue. So your earned revenue is based on your progress complete times your contract price. So it kind of all builds together. So if your estimated costs on a job are $1 million and you've spent 500,000, that means you are 50% complete, assuming you're using the input cost to cost method, which 99% of people do, then you're 50% complete. If you're 50% complete, that means you can recognize 50% of the contract price as revenue. And then you can compare that revenue to your billing. So if you earned revenue is $1 million and you've billed 900,000, you're under billed by 100,000. If your earned revenue is $1 million and you've billed 1.1, you're over billed by 100,000. That's kind of the easiest way to explain it, even though you need all the other numbers to get there. As far as analyzing over and under billings, I'll just give you kind of how we look at with CPAs, with banks, with bonding companies. So over billings are the better of the two. That means that you're pre-billing, which isn't necessarily a bad thing, or your gross profit is lower than what it actually is going to be, which is also a good thing, means you're being conservative. The thing we look at with over billings, just to get comfort as accountants, is are you collecting on those billings? So if you're billing, and you're overbilled by 20%, but you're not collecting any of the money, then I have a problem. Are they not accepting your billings? Are they arguing, going back and forth? Are they trying to hit you with back charges? So that's what we kind of look at as overbilling. It's not a bad thing, but we want to make sure that you're consistently collecting on those pre-bills based on your progress that you're sending. Underbilling has a little bit more of a negative connotation. The concept being, why are you not billing for work that you've done? That's the question that everyone asks. As far as an underbilling percentage, we as CPAs typically look at anything over 5% of the contract price. So if you're underbilled by more than 5% of the contract price, we'll start to ask that question. And there's a variety of reasons as to why you could be underbilled. Some of them completely valid and should be easily explainable. If you can explain it, then you could be missing costs, or your gross profit margin is actually less than what you're showing, which is not what we want. So I could go on and on about over underbilling, but that's kind of what we look at as like the key areas and the overall concepts.
That's good. No, I think that's a good summary. So Michael here is asking, does Foundation charge for custom reporting, or is it part of the cost of the monthly subscription? So I'll take this. The short answer is it depends. As Melissa said, Foundation, it's designed obviously for construction, right? We have a lot of reports that are canned, that already exist in the system, that if you run different ways based off the criteria and sort and subtotal options that you set, they are softly customizable and they might get you what you want. We also have the Data Genie Report Designer, which you should have some training with through the implementation. If you're familiar with, you can obviously take a stab at creating some of these reports. And the support team, just the general, customer support, they can help guide you through that if you have questions. Like, they can't sit down and write an entire report with you, but they can guide you with where you might be stuck. Hey, you're trying to write a formula to do a calculation and it doesn't seem to be working, et cetera. So that would all be included in your subscription, et cetera. But as you get into some more complex things, I dealt with this a lot, where sometimes what you want to do in the software might not be necessary or might not be possible with the report designer. And that's where we can get into creating reports through Excel, through queries, by connecting to your database and doing those. And that's the type of thing that would be billable over and above the monthly subscription as part of our consulting team. So it really just depends on what you're looking for. And again, if it comes down to getting the data into the system so that it is able to be drawn out for reporting, that's a whole separate part of implementation or consulting as well. So that is that. I don't see any other questions up here. So at this point, I think we can call it a day. I want to thank the attendees, everybody who showed up and gave us your time and attention. Very much appreciate you being here with us. Melissa, thank you for prepping and a great presentation. A lot of good information there. Hopefully everybody found it helpful. And I guess until next time.
Sounds great. Thanks, everybody.
Have a great day.
Bye, guys.